The United States government spent $1 trillion on interest payments last year. Not on defense, not on healthcare, not on infrastructure or education or social security, just on interest. Just on the cost of borrowing money that was already borrowed years ago. $1 trillion gone before a single new program was funded, before a single new road was built, before a single new anything happened. To put that number in context, the entire U.S. defense budget, the aircraft carriers, the fighter jets, the military bases around the world, the entire global military apparatus of the most powerful nation in human history costs about $850 billion a year. America is now spending more money on the interest on its debt than it spends on its entire military. And here's the part that should make everyone stop and actually think about this. That $1 trillion in interest payments is not the peak, it is the starting point. The Congressional Budget Office, the nonpartisan office that scores the federal budget projects that interest payments will more than double to $2.1 trillion by 2036. And by 2056, they reach $6.6 trillion per year. That is a 538% increase from where we are right now. By 2028, not in some distant theoretical future, but in 2 years, America will spend more on debt interest than on Medicare. By 2038, interest payments will exceed defense spending. And by 2048, interest on the national debt will become the single largest expenditure in the entire federal budget, larger than Social Security, larger than defense, larger than everything. We are not approaching a debt problem. We are already inside one. And the reason almost nobody is treating it with the urgency it deserves is that the consequences are arriving slowly enough that each individual step feels manageable right up until the moment it isn't. Let me explain exactly how this happened, why it's worse than it looks, and why, and this is the part that should concern everyone, the normal tools for fixing it no longer work the way they used to. Let's start with the basic numbers. The U.S. national debt just crossed 100% of GDP. That means the total amount the federal government owes is now equal to the entire economic output of the United States for one full year. Every dollar of value created by every worker, every business, every transaction in the American economy for 12 months, that's what the government owes. In 2000, the debt was 55% of GDP. In 2008, before the financial crisis, it was 67%. The crisis pushed it to 100%, and then the pandemic pushed it higher. Now it sits at 101% and is projected by the CBO to hit 120% by 2036 and 175% by 2056. The structural problem is not just the size of the debt, it's the trajectory. Because for most of the past 60 years, America had a crucial mathematical cushion. The interest rate on the debt, the rate at which borrowing costs were growing, was lower than the rate at which the economy was growing. Economists express this as R less than G, rate of interest less than rate of growth. And when R is less than G, the debt is manageable in the long run. The economy grows faster than the interest compounds. The burden gets smaller relative to the size of the country. But by 2031, 5 years from now, the CBO projects that R will exceed G. Interest on the debt will be growing faster than the economy's ability to pay for it. The Committee for a Responsible Federal Budget calculated that closing this gap alone would require roughly $2.7 trillion in annual spending cuts or tax increases. That is more than the entire current discretionary budget. It is essentially the entire defense budget plus all non-defense discretionary spending combined. There is no political reality in which $2.7 trillion in annual adjustments happens, which means the gap is not going to be closed through normal policy. And that creates a problem that is more alarming than the debt number itself. This is where a concept called fiscal dominance enters the picture. And I want to take a minute to explain this properly, because it is the most important and most under-discussed consequence of what is happening with America's debt. Think of the U.S. economy as a car. The Treasury Department is the accelerator. It controls government spending, which puts money into the system. The Federal Reserve is the brake. It controls interest rates, which it raises to slow inflation when the car is going too fast. For decades, this system worked well. When inflation rose, the Fed hit the brake. Rates went up, borrowing slowed, spending cooled. Inflation came back down. The engine of the economy responded to the controls. But now, the car is towing a $38 trillion trailer, and the trailer changes everything. When the Fed raises interest rates to fight inflation, as it did in 2022 and 2023, and as it might need to do again given the current oil shock, the cost of servicing that $38 trillion debt rises immediately and dramatically. Every percentage point increase in rates adds roughly $380 billion to the annual interest bill. At $38 trillion of debt, raising rates is not just painful for borrowers, It is directly and immediately costly to the federal government in a way that constrains its ability to function. This is fiscal dominance, the point at which the debt has become so large that the government's financing needs start to constrain the central bank's ability to fight inflation. The brake stops working properly because hitting it too hard causes a different kind of crash. Former Treasury Secretary Janet Yellen and top economists including Eric Leeper at the University of Texas have been warning about this explicitly. When the debt was 25% of GDP, as it was during the Volcker era of the early 1980s, when the Fed raised rates to 20% to crush inflation, the government had time to adjust. The debt was small enough that the interest impact was gradual and manageable. Volcker could be brutal with rates because the fiscal system could absorb it. At 100% of GDP, that time no longer exists. A rate hike hits the interest bill immediately and at massive scale. And that constrains exactly the tool the Fed needs to fight the inflation that the oil shock is currently threatening to reignite. This is why the debt problem is not an abstract fiscal concern about future generations. It is a structural constraint on the policy options available to manage the economy right now, today, in 2026, during a period of genuine economic stress. But wait, and this is the part that I want you to really stay with, because the mechanism by which the debt affects ordinary people is not just through government policy. It runs directly through the bond market into your mortgage, your car loan, your credit card rate, and the valuation of every stock in your portfolio. Here is the chain. The U.S. government has to fund a deficit of roughly 5.8% of GDP this year. That means the Treasury needs to sell enormous quantities of bonds, government IOUs, to whoever is willing to buy them. When demand for those bonds is high, the Treasury can sell them at low yields. When demand is insufficient relative to the supply, yields have to rise to attract buyers. And here is the uncomfortable reality of 2026. The traditional buyers of U.S. government debt are not buying as much as they used to. Foreign central banks, China, Japan, the Gulf states, have been diversifying away from U.S. treasuries for years. We covered the Japan story in a previous video. The Hormuz crisis has disrupted the Gulf states, and China has been systematically reducing its treasury holdings as the geopolitical relationship with the U.S. deteriorates. The domestic buyers, American banks, and financial institutions are absorbing more of the issuance. But at some point, the sheer volume of new debt the Treasury needs to issue creates a supply-demand imbalance. And when that happens, yields rise. Not because the Fed decided to raise rates, because the bond market is demanding more compensation to absorb the supply. This is what Ray Dalio means when he says the bond market is the backbone of all asset prices. When Treasury yields rise for any reason, including insufficient demand for a massively indebted government's paper, the cost of money goes up everywhere. Mortgage rates go up. Corporate borrowing costs go up. The discount rate that investors use to value stocks goes up, which means stock prices go down. The national debt is not an abstract number on a government website. It is the single most important structural variable determining the cost of money in the American economy. And it is now at a level where it is beginning to actively constrain the flexibility of every economic actor from the Federal Reserve to the ordinary family trying to buy a house. Now, let me be honest about what the solutions are, because there are really only 4 options, and none of them are painless. Option 1, grow your way out. If the economy grows fast enough, the debt shrinks as a percentage of GDP, even without cutting spending or raising taxes. This is the preferred political solution because it requires no hard choices. The problem is that the math requires sustained GDP growth of around 3.5% or more at a time when the long-run growth trend for the U.S. economy is closer to 1.7% to 2%. Productivity gains from AI could help, and some economists are optimistic about this. But the CBO's projections, which are among the most credible available, do not assume an AI productivity miracle, and even with reasonable growth assumptions, the debt keeps climbing. Option 2, cut spending dramatically. The numbers required are so large, $2.7 trillion in annual adjustments, just to stabilize the debt ratio, that the political reality of achieving them is essentially zero. The largest discretionary programs, Social Security, Medicare, defense, are politically untouchable. Everything else combined is not large enough to close the gap. Spending cuts alone cannot solve a problem this size. Option 3, raise taxes dramatically. Also, politically constrained, and the economic impact of the tax increases required to close a gap this large would be contractionary. You cannot raise taxes by $2.7 trillion annually without significantly slowing the economy that is supposed to be generating the revenue. Option 4, inflation. The one that nobody says out loud but that fiscal dominance essentially guarantees as the default. When a government cannot grow fast enough, cut enough, or tax enough to service its debt, the historical resolution is that the real value of the debt erodes through inflation. The debt stays nominally the same, but the dollars it's denominated in are worth less. Creditors get paid back in depreciated currency. The real burden shrinks. This is not a conspiracy theory, it is a documented pattern across every instance of fiscal dominance in modern economic history. And it is exactly what Janet Yellen and Eric Leeper are describing when they warn that the adjustment for an excessively indebted government happens through the purchasing power of money rather than through taxes or spending cuts. For the ordinary person, inflation as the resolution to a debt spiral means the following things in practical terms. The purchasing power of savings slowly erodes. Fixed income bonds, savings accounts, anything paying a fixed rate underperforms. Real assets, property, equities, and businesses with pricing power, commodities tend to hold value better. The people with financial assets and the knowledge to reposition them do better. The people without the ones whose entire financial position is a savings account and a pension do worse. And on top of all of this sits the oil shock. Because the Iran war and the Hormuz crisis have injected an inflationary impulse into an economy that was already structurally constrained in its ability to fight inflation, the Fed needs to keep rates elevated to prevent the oil shock from becoming embedded inflation. But keeping rates elevated accelerates the debt spiral by adding to the annual interest bill. And adding to the annual interest bill makes the fiscal dominance problem worse. And worse fiscal dominance makes it harder for the Fed to do its job. The oil shock, the debt crisis, the fiscal dominance risk, and the housing affordability problem are not four separate stories. They are four expressions of the same underlying constraint, an economy that borrowed against its future at historically low rates for a decade and a half, and is now reckoning with what happens when those rates are no longer low and the debt is no longer manageable through normal channels. None of this means collapse is imminent. The United States has enormous structural advantages: the reserve currency status, the depth of its capital markets, the size and diversity of its economy, the innovation capacity that AI is currently demonstrating. These are real buffers. Countries with these buffers can sustain debt levels that would be catastrophic for a smaller or less structurally advantaged economy. But buffers are not solutions. They are time. And time is not being used to solve the problem. It is being used to make it larger. By 2036, interest on the national debt will consume 25.8 cents of every dollar the federal government collects in revenue. That is 1/4 of all tax revenue gone before anyone decides to spend it on anything. And by the time the NBER confirms the recession that may already be beginning, by the time the oil shock fully filters through to food prices in 6 months, by the time the housing market finishes, adjusting to mortgage rates that may test 7% again, the federal government will have less fiscal space to respond than at any point in the history of the United States. The car has a $38 trillion trailer, and the brakes are heating up, and the road ahead has more curves in it than anyone is publicly admitting. So where do you land on this? Do you think A, the U.S. debt is genuinely on an unsustainable trajectory, and the resolution, whether inflation, fiscal crisis, or dramatic policy action, is going to be painful for ordinary people in ways that haven't been priced in yet? B, the reserve currency status and AI-driven productivity gains are real enough buffers that the doomsday scenarios consistently overestimate America's resilience. Or C, this is a real problem, but it has been a real problem for 30 years, and the consistent failure of predicted crises to materialize suggests the system is more robust than the numbers imply. Drop your answer in the comments, because this one has been debated by economists for decades, and the honest answer is that nobody knows exactly when the math stops being theoretical and starts being lived.